The United States just issued a bold warning to BRICS: stop trading without the US dollar. But BRICS had a surprising answer: a $648 billion trade explosion, with the majority of it happening in Chinese yuan. This isn't just about money, it's a major shift in power. And now, in a state of urgency, Trump is reaching out to President Xi, not to strike new deals, but to slow down the dollar's rapid decline in global influence. Because if this diplomatic effort fails, it's not just a drop in dollar value, it could trigger a financial crash. Across markets, U.S. bonds are being dumped in large volumes, driving up America's borrowing costs. But here's the strange twist. The U.S. still depends on China to power its military industry. It borrows money from China, uses it to buy Chinese minerals, then uses those minerals to build weapons aimed at containing China. That's not just irony, it's a serious national dilemma. China has achieved something Washington didn't think was possible: $648 billion in BRICS trade in just 9 months. And over half of it took place outside the dollar system. This isn't speculation, it's straight from China's General Administration of Customs. They reported a 5.1% rise in year-over-year trade. That's notable by itself. But what really stands out is how that trade is happening. As of March, 54.3% of transactions were settled in yuan, also known as renminbi. US dollar usage fell to just 41.4%. For comparison, back in 2018, it was over 70%. This isn't just economic change, it's a loud geopolitical signal. Bloomberg confirmed that China's Foreign Exchange Office reported a record-breaking 724.9 billion yuan in cross-border transactions in just 1 month. The message is clear: the yuan is gaining strength, while the dollar is losing ground. Now Washington is realizing the threat. Behind closed doors, it's sending quiet warnings to BRICS leaders, asking them to reconsider. But why would they? The US's aggressive tariff campaigns meant to isolate China are the very reason these countries came together. Beijing isn't trying to lead a currency revolution with speeches or slogans. It's doing it with strategy, one trade agreement at a time. The People's Bank of China just announced support for yuan-based financial services in Shanghai, aiming to make local currency trade standard. BRICS economies now make up nearly 30% of global GDP and almost half the world's population, and instead of resisting, they're pushing this shift forward. China's exports of critical goods like aircraft components and semiconductors to BRICS countries jumped over 10% year over year. Over 80% of poultry and frozen fish imported within BRICS now come from member nations. According to Hong Yong from China's Ministry of Commerce, this isn't temporary. It's a full realignment of trade flows. Meanwhile, U.S. Treasury Secretary Scott Bessent is raising red flags, claiming China's moves destabilize global markets. Let's ask, what's really unstable? Is it countries using multiple currencies, or using one currency as a political weapon? Trump's so-called reshoring plan, originally pitched to bring U.S. jobs home, is now, interestingly enough, looking more like a policy that's boosting China instead. Since April, the U.S. has slapped tariffs as high as 145% on Chinese products. There's also this new 10% baseline tariff on many imports, even from nations with fair trade ties. But rather than shrinking China's exports, this is simply reconfiguring global trade. According to April numbers from China's SAFE, international trade hit $668.8 billion, a 6% rise from the year before, despite a global slowdown. The world isn't pausing. Countries priced out of U.S. imports are turning to China, and more of them are now trading in yuan. Economist Gary from Natixis told Bloomberg something pretty key. From a global perspective, firms now have strong reasons to avoid using the dollar altogether, and that's the twist. The tariffs meant to isolate China, they're actually bringing more countries into China's economic circle. JP Morgan has warned that the decline in dollar-based transactions isn't just a theory. It's already cutting into global demand for U.S. Treasury bonds. And this isn't just a number on a screen. It strikes at the very heart of America's financial stability. Back in 2009, a McKinsey report found that foreign buying of U.S. Treasuries helped lower borrowing costs by about 50 basis points, saving the U.S. nearly $90 billion annually. Apply that to today's $37 trillion debt load, and the potential costs from falling foreign demand could run into hundreds of billions each year. According to Bloomberg Intelligence, interest in U.S. Treasuries has dropped for 4 straight quarters, and for the first time ever, America is on track to spend over $1 trillion just on interest payments in 2025. Meanwhile, China has quietly been unloading its U.S. bond holdings, gradually, but consistently. And yet, despite all these red flags, Washington's main move is to pressure BRICS countries to keep using the dollar. That's not a well-thought-out plan. That's a reaction rooted in desperation. At the 16th BRICS Summit in Kazan, Russia, the group greenlit additional funding for the new development bank, which now manages over $35 billion in loans. These aren't small projects. They're financing green energy tech networks and huge infrastructure efforts. And unlike loans from the IMF, they don't come with U.S.-centric conditions. China's steel exports to BRICS have risen 8.6%. Textiles are up 13.4%. Electronics, like tablet screens, are also seeing strong growth. This isn't random. It's a carefully executed plan. The BRICS message is clear. They're stitching together a new network of trade and finance, built to function without relying on the West. Liu Ying of Renmin University says this isn't just about trade, it's a stand against rising protectionism. So when Washington demands that BRICS stop non-dollar trade, it's not halting an experiment. It's trying to rewind a model that's already delivering results. But here's the bigger question. What if this system doesn't need the United States at all anymore? For decades, the U.S. dollar quietly powered the world, enabling cheap imports, global trade dominance, and military reach. But when that engine starts to stall, the fallout is real. Compare that to BRICS nations like India, Brazil, and China. Despite turbulence, their economies are barely shrinking, less than 0.1% in some cases. Why the difference? These nations aren't leaning on massive foreign debt. They're building stability from the inside. Sure, tariffs boosted U.S. revenue in the short term, but the burden fell on American consumers and importers. According to Bloomberg, the money didn't come from foreign nations. It came from Americans paying more. The upcoming phone call between Trump and President Xi? Well, it's not just routine. It could shape America's industrial future. Without a rare earth supply deal from China, the entire Made in America push could stall. And this isn't just about materials, it's a test of the dollar's future. Senator David Perdue tried to downplay it, calling it typical diplomacy, but China's silence says otherwise. Beijing knows it holds a winning card. World Bank data shows that less than 3% of China's GDP depends on exports to the United States. Meanwhile, the U.S. relies on China for over 87% of refined rare earths, essential for everything from fighter jets to smartphones. Treasury Secretary Scott Bessent told CBS that cutting off industrial components is not how partners behave. But that warning may not land. Because China isn't defending, it's taking the offensive. Low interest rates, high domestic demand, and growing yuan liquidity give Beijing tools to weather pressure. The Trump-Xi call might lead to a temporary peace, but if it fails, the fallout could be fast and painful. A sudden sell-off of U.S. Treasuries is not out of the question. That's the kind of shock no press briefing can soften. Traditionally, diplomacy starts with cooperation, but right now the U.S. is doing the opposite. It's asking BRICS to keep using the dollar, while hitting those same countries with punishing tariffs. Even close allies aren't safe. The UK maintains a balanced trade with the US, but still faces Trump's new 10% baseline tariff. And Japan? A longtime trade partner now has $118 billion in exports at risk. Reuters says this puts Japan in a vulnerable spot as the global map shifts. BRICS countries are told to be dependable, while being punished for bilateral trade. Besant recently suggested China should consume more, produce less, a soft request for China to slow down so America can catch up. But Liu Ying puts it plainly, China's manufacturing power isn't just economic, it's a shield against outside pressure. So the question becomes, at what point does all this stop being policy and start looking like political theater? This isn't just a disagreement. It's a full-blown test of the United States financial system. Sure, one phone call might delay the symptoms, but the truth? It's already in the numbers. What we're seeing isn't a collapse. It's a gradual erosion. One trade deal at a time, one contract after another, settled in yuan, not dollars. It's not symbolic. It's a real strategic shift. And here's the twist. If BRICS keeps going and Trump keeps escalating tariffs, we're on a collision course. Let me ask you this. If you were in their position, would you stick with a system that no longer benefits you or take the leap into a new one? Tell me in the comments. I really want to know, what would you choose? And don't think this is the end of the story. China has more moves in its playbook, and what's coming next might be even bigger. So hit that subscribe button, because the next chapter could reshape everything we know about the global economy. And if you've watched all the way to here, give this video a like, subscribe if you haven't, and check out the next one. It digs even more deeper than this.